Okay, we're going to do a quick video here on what's driving a stock like GME to these levels of 380 and higher. I mean, it's traded $380. And so just back in, well, last year in April, this was so at the end of the bear market, this was $2. But really, in recent history, it's come from around five, 4 and 5. And it did get into this, nice rising channel, a five-wave move up and then pulled back. And in here is where I think is where everybody started talking about shorting this stock. And I think up in here at was it the Citron put out an alert on this stock in around this, I thought it was around $30, maybe it was 20. And so it doesn't matter. It's a moot point. It's at 380. So whether it was 20 or 30 is irrelevant. And Citron has big pull in the market when they put out both a long and a short. And this is probably it here. And it sold off quite sharply and based in here. Then what happened was we've got this new phenomenon that's going on where the retail traders, the Robinhood, and we've seen this, we call them the Robinhood traders. I don't know if it is. I mean, it could be, they could be trading a lot of places, but it really showed up in the new platform Robinhood, and everybody was in there and retailing. And what showed that this was a lot of retail was the size of the orders. It wasn't big institutional orders, guys buying 100,000 shares. It was small traders buying 10 shares, 50 shares, 100 shares, and buying the stock and driving it up. And then the social media got a hold of it and started to drive it. Now, is that enough to take this stock to this has 69, this has 70 million shares outstanding. So at 70 million shares at this price, I mean, what's that? That's 21 billion. What's the market cap? 21 billion? I should know that. Off the top, I should be able to calculate. 23 billion. So the market cap right now is about 23 billion. So is it enough? I mean, can the Robinhood buyers, we'll just call them that for lack of a better term, is the retail, the tiny retailers, is that enough to trade a stock 70 million shares a day at $350 a share, a market cap, with a stock that has 79 billion outstanding? I doubt it. It's a factor for sure, especially early in the game. And you see these big swings in it. If you look back, come on. Before it really went crazy, I mean, we thought this was crazy. It traded from 50 to 70 and then down to 60 and back up to 80. You probably, those kind of, and these kind of and look at being the pre-market, this huge spikes up and now consolidating it. And so the swings will, though they're big, can the retail markets trade a stock with 21 billion market cap? It's traded, what did I say, how many shares it traded today? It's traded 65 million. That's 20 billion in trading today. So there's something else that's going on here as well, and I'm not trying to suggest that the retailers can do it, but there's something else going on here as well. Part of it is the short sellers and big institutions. And there's been a lot of social media on this where the big institutions are taking on the tiny retailers. And the big institutions, the hedge funds and such, are shorting this stock because it's a big float stock, 79 million, so there's probably lots of stock to borrow. And absolutely getting crushed. But they're not getting crushed necessarily by the retail traders. That's not the whole story here. So when you do get a big short position like this in the stocks, and everybody's shorting, you do get what's called a short squeeze for sure, where the shorts are selling to the shorts that are covering, and it sort of escalates its way up like a ladder. Everybody's scrambling to get on top of the other guy, and the other one just above him selling down, trying to sell them down. So you get a big short squeeze. That's one of the reasons this trades like this for sure. But another problem with, or not a problem, but one of the other reasons, and this is probably not that well known, is that you get a big squeeze like this, is that a stock like GME has options. And there is market makers out there. Now the market maker is looking to stay neutral. They're there to make the market. They're not there to, they're scalping it for sure, but they're not there to buy the stock and drive it higher. They're there to make a market. And so what happens is, to reduce their risk, and you have huge option buying, they need to offset the option buying by they need the ability to deliver the stock. So they, as the options increase and more people are buying options, call options, and if they exercise those call options, somebody has to be able to deliver that stock. And so if the market maker sees a big option position on play, they need to buy the stock to be able to deliver against the options that people are buying. Now, don't forget, that's highly leveraged, like 6 times or 10 times, the value. So that really, really drives the market higher as well, as the option go in, more and more options, and as the market goes higher and higher, the market makers need a position. They can't be looking to buy stock at 300 if they need to deliver it at at $20. So every day as the options come in, the market makers are buying the stock to hedge their position against the big option buying, and that is probably a bigger, or as big as the short squeeze and the retailers combined, that those two things going in there, because it's so highly leveraged. That's my theory. For the easiest way to explain it, though, and for everybody understands, it's just it's a short squeeze, and for sure it's a short squeeze, but that's not all that's fueling it. The market makers need inventory to offset the option side of the trade, and then just to give it some extra pizzazz, the retail buyers are in there, trying to drive it up. Now the retail buyers could be, there's a huge amount of money out there, but there's a lot of stocks too, so that are popping, and there's only so much money to go around. But this is really going to start to fuel it. There's no doubt. A stock going from $5 to $360, and we'll just trade it as we see it. So there you go. That's my theory on why a stock like GME runs. It's not just shorts. It's not just the retail, but it's also the market makers needing to hedge their positions.